Hi, everybody. It's Marcus, Condominiums Properties. So, can you believe it's already April, which means we can do a January, February, March, or Q1 2025 Lexington market update. So, let's get started with that. There's going to show you a lot of information today, and I thought it would be useful to give you the source of this information because there's a lot more there as well. I'm going to focus, of course, on Lexington. But if you're interested in any more information, then head on to miproperties.com statistics. There you will find lots of different stats for about 50 different towns. So lots and lots of information there if you're into information. So first place to go. Secondly, for those of you who live in Lexington, you should have received the Lexington Market Review 2024-2025 Market Review in the mail in late January. We've done this for about 10 years now, in fact, exactly 10 years. This is our 10th copy. And in there, we focus on single family, condominium, luxury, and new construction markets. And then we give a detailed prediction of what we see for the upcoming year, in this case, for 2025. So lots of information in there, very detailed information in there. If you would like a copy, it's on our website. But also, if you'd like a hard copy, just let us know. We can get you a hard copy of that because there's lots and lots of information within that. So I'm going to focus kind of a broad overview. As ever, I'm going to go into some detail because that's, as those of you who've watched these before will know, we do a little bit of detail. But I'm going to look at, again, those same sectors I talked about with the market review: single family, luxury, new construction, condominiums, and then what's happening in the market. And then I'm going to try and give you my 2025 predictions. Clearly, there has to be a huge caveat on that. Very, very uncertain at the moment, seems like from day to day. And some of that's going to have an impact on the housing market, some of it not so. But I thought we'll try and give you a sense of where we are, looking at what happened in Q1 anyway, try and kind of extrapolate what we anticipate for the rest of the year. So, single-family homes. First thing to look at is the number of homes that are listed, and the trend here is pretty clear. We were relatively static in terms of the number of homes listed until we got to 2020, COVID. High number in 2020, and it's really been declining ever since. And we've been waiting for that kind of turnaround, if you like, in terms of when sellers will come back into the market. The reason is pretty clear. One, a kind of a carryover from COVID. Lots of people made the move in 2020, but then as interest rates began to rise, many sellers found themselves with a very advantageous mortgage rate, 3-4%. But if they bought a new home, then that would rise upwards to 6, sometimes 7%. And that was a real curtailment, really, to sellers putting their home on the market. As we come to 2025, as you can see, we had 85 listings in Q1 of 2025. Now compare that to Q1 2024, where there were only, he says, 68. So a marginal increase in the number of listings coming on the market. And anecdotally, we've seen this as well in our business. Sellers having waited long enough, I don't think anything's going to change dramatically over the next couple of years. I've been waiting to sell, so hey, let's put our home on the market. And so we're seeing that as well in sellers that we're talking to, and you can see it also in the data. We are beginning to see the sellers come back into the market, which, as you can see, given the decline we've had over the last, 4 years there, which is a good thing. So that's what we're seeing in terms of the homes listed. Not quite as good a story, unfortunately, in terms of the homes sold. So homes listed, I think I would treat as a seller confidence, perhaps seller sentiment, if you will. Now we turn to homes sold, and then a couple of key metrics like days on the market and the sale price list price ratio. That's really buyer sentiment focus. So as you can see, we've got about 31 homes that have sold in Q1 2025 in comparison to 46. So 31 in 25, 46 in 24. So we've seen a decline in the number of homes sold, even though the number of homes listed is clearly higher. So we have something about kind of an excess of inventory here. The hope is, of course, that that excess inventory is short-lived, and as the market kind of carries forward, we get into the main part of the spring market, so that excess inventory will be sold. Time will tell on that one. But there's clearly not as much confidence in the in the buyer, than there is in the sellers. So 31 sold this year, 46 sold last year. A couple of other metrics worth taking a look at, see if we can kind of glean anything else, albeit only 3 months worth of data. The average days on the market, slightly less than we saw in 2024, which is a good thing, but not by very much, essentially. It kind of around about that number, and we'll see as the year progresses the way that goes. Difficult to make a prediction in Q1 how we see that changing moving forward. The other metric we look at is the sell price to list price ratio. That is, if a home comes on the market for $1 million and sells for $1 million, that's a 100% sell price to list price ratio. That ratio is up at 102%, which is about consistent with what we saw over the last 2 years. So no big increase and no big decrease in terms of that. It's kind of business as usual. Although what's interesting is that we often see a much higher number in the first 3 months of the year. That is that very few sellers coming on the market, lots of buyers kind of woken up as the new year happens. This is the year they're going to buy. And so we do tend to see in Q1 a higher sell price to list price ratio, historically anyway, a higher sell price to list price ratio in Q1 than we see for the year as it unfolds. So that 102, consistent with the whole of last year, does imply to me anyway that we're not seeing as confident buyers in the market in 2025 as we saw in 2024, where the average ratio in that first 3 months could well be 104, 105%, certainly. So we are beginning to see sellers coming into the market, but buyers being a little bit hesitant to come in and consume all of those listings. The average sale price, I guess what everybody cares about. Unfortunately, very few sales, and as I'll show you in a moment, some new construction sold at a higher price point, and that skewed the average. So even though the average for Q1 is 2.15 million, this is too high. It will creep down as the year progresses. And if I break this down in terms of new construction and existing homes, so the blue line is new construction, the red line is existing homes. What you can see is quite a dramatic rise in the price of new construction homes from 3 million in 2024 upwards to about 3.4, 3.45 in 2025. So a big increase in new construction prices, but actually a slight decrease, not by very much, and let's let the rest of the year play out, but a slight decrease in the existing or non-new construction homes. And that difference in appreciation, negative for existing, high for new construction, is what skewed that average. So don't read too much into that average. It will begin to come down as the more sales happen and the year progresses. So that's kind of where we are with the single-family home market. Let me look now at the luxury market. Now, we changed our definition of the luxury market in 2025. Historically, we've kind of crept it up over the years anyway, but last year and for a few years prior to that, 24 and plus for 2 or 3 years prior to that, we had it at 2.5 million. To that, we had it at 2. That seems kind of out of kilter now with the average price in 2024 approaching $2 million. So we've moved it up to $3 million, so a sale price of $3 million and above. We're going to carry that on through 2025, and we'll see, depending on where prices go, whether we need to kind of bump that up a little bit more for our 2025, 2026 market review. But for now and throughout 2025, I'm going to keep it at about $3 million. At $3 million. About $3 million. So let's take a look at the number of homes sold. In this graph, the blue is existing homes, non-new construction, and the green is new construction. And as you can see, the above 3 million, certainly in 2024, really dominated by new construction homes. You can see that 20 new construction, whereas only 9 existing homes sold in 2024. We currently have 7 homes sold in 2025. So how does that compare to 2024? Excuse me while I look down at my notes. So in terms of the number listed, it's kind of quite interesting. In 2024 in Q1, we had 10 over 3 luxuries. We got luxury from this point forward. Luxury homes listed. That number increased actually dramatically to 24 in 2025. So we went from 10 in 24 to 24 in 2025. So big increase in the number of luxury listings between those 2 years. Now, in terms of the number sold, we sold 5 in Q1 2024. So 10 came on the market, and 5 of those were sold in Q1. In terms of 2025, 7 have sold, so an increase clearly, and 7 are under agreement. What's interesting, though, is that we're looking at the data and kind of extrapolating it out. It could well be that we're going to have, even based on the luxury homes that are on the market today, about 12 months worth of supply of the over 3 million. So that's interesting. If any more come on, and it's likely that they will, be it new construction or existing homes, that could push that, what we call the absorption rate, over 12 months. So today, we have around about 12 months worth of supply actually on the market. And what that means is if no new homes came on the market, the existing inventory would be consumed in 2025. Any more come on, and we could find ourselves in a kind of oversupply situation. So that's kind of where we are with new construction, luxury. I'm going to do new construction next. Days on the market, higher than we see in the overall market at 70 days. Less than interesting we saw in 2024. So less, we would expect this actually. This is more consistent with what we've seen in prior years. Back to what I said around sale price to list price ratio too. Lots of homes, very few homes come on the market in that kind of Q1 period, but the buyers are out. What that tends to do is increase the sale price to list price ratio, but also decrease the days on the market. And we're beginning to see that in the luxury market. The days on the market has declined to 270 days, but that's still 3 times as long as it would be for the overall market. In terms of the sale price to list price ratio, clearly very depressed at 93% versus 102 for the market as a whole. What's going on here as well is price reductions by the developers. Carrying costs, interest rates are high, therefore carrying costs are high. And what we're seeing is developers reducing prices to move the inventory that they have. That means they sell quicker, I should say, but also means they sell for a lower sell price to list price ratio. So what you're seeing here in that 93% is that developers doing those price reductions, discounts as it were, to move that inventory so that they can avoid the high carrying costs that would be entailed with building a new construction. Because remember, unlike existing homeowners who can delay putting their home on the market, they could stay in the home for another 12 months. Developers are constrained in that they really do need to shift the home, sell the home. Therefore, they are compelled to some extent, if it's not selling, to actually discount to move it to sell it quickly. So that's what's happening in the luxury market. I say $3 million and above sell price. New construction. There's kind of a variable picture in terms of the number of new construction homes that are sold, built and therefore sold. And there's a lot of detail here, which I go into in lots of detail in the market review in terms of oversupply, overbuilding, as it were, in the aftermath of COVID and the year or so after that, and so I won't go into the detail here. I recommend you read the new construction section in the market review. There's lots of information there about what's going on. But let's take a look at listings versus sales. So listings in 2024 were 14 new construction homes. Listings in 2025, 21. So more new construction homes coming on the market in 2025 versus 2024. In terms of the numbers sold in Q1, though, 9 were sold in 2024, 11 were sold with 300 agreements, so 14 or so slightly higher number of sales in 2025 versus 2024. So listings are up, sales are up, which is a good thing. And it looks to me that we could well be in a kind of balanced market in terms of new construction as the whole year plays out. Similar picture really to luxury, no surprise. The luxury market is dominated by new construction, so the overall characteristics are very similar. So that's kind of where we are with that. Looking like the number of homes coming on, they will probably sell, but it will take the rest of the year for that actually to happen. That's what it looks like. Same way as we saw with the luxury market, slightly stronger sell price to list price ratio, but still 96%. So it is much lower than the overall market, a little bit higher, but consistent really with that luxury market. And that's because there's a great deal of overlap between those two sectors. Okay, so let's take a quick look at condominiums. Here's the condominiums listed. As you can see, we're at about 18. In 2024, there were 11. So slightly more condominiums listed this year than last year, similar to what we see in the overall single-family home market, of course, just as I explained previously. And in terms of the number of sales, 2024, we saw 7. 2025, we saw 11. So condominiums are actually selling. And it doesn't look like, based on the data we have so far, we've got too much of an oversupply, unlike the single-family home market. So a little bit more of a balanced market in terms of the number of condominiums with, let's say, 18 coming on the market, 11 selling, whereas last year, 11 came on the market, 7 sold. So very similar characteristics to what we saw last year. In terms of the average price, here I've broken out just the existing condominiums. Condominium market does tend to be dominated by peaks and troughs caused by new construction condos coming on the market, which are often much far higher priced than the existing condominiums in Plot Pond and Piper Lane and so on. So we are beginning to see a slight increase in that average price. It's not, let's say, I backed out the new construction. So this is more a more accurate sense of where price appreciation is. So 907 to 924, not that high, in the single digits in terms of appreciation, which is what we've seen in the condo market for the last 2 or 3 years. So that's the condominium market. And I'll give a sense of kind of what's happening. Much of this is very similar to what I said, a couple of months ago, but I thought we'll kind of reiterate it. Really, the market is dominated by these very high mortgage interest rates. Many sellers or homeowners, I should say, potential sellers, bought back in the early 2000s, 2020 and previously. And so they're to some extent locked in, at least mentally, to that 3 or 4% mortgage interest rate. Perhaps they bought previously and refied, so they've got a very low interest rate. There's a real disincentive, given the sharp rise we saw in 2022 and 2023, a disincentive for them to bring their home on the market and move from a 3% mortgage to a 7%. The one caveat, or the one sector which isn't affected by this as much, of course, are the downsizers. And that's really what we're seeing in terms of the market. We're seeing downsizers who are moving perhaps to no mortgage, or certainly a smaller mortgage. And so they're not that worried about the mortgage interest rates. And then relocations, of course, happens as the normal kind of the way the housing market works, but dominated to a large extent by downsizers who are not necessarily so impacted by that mortgage interest rate, which, as you can see here, and if I kind of narrow this down over the last 23 through to here we are, Q1 2025, it hasn't really moved very much. It's between 6 and 7%. And lately, it's been around about mid 6s. It really hasn't done very much. And what we really would like to see clearly, and at least today it doesn't look like it, we'd like to see a nice steady decline in those interest rates. This is the latest data we've got. have to say, given where we are economically, will tariffs lead to inflation? Will increased inflation lead interest rates, and all of that kind of playing out? I don't think anybody's brave enough, and I'm definitely not, to say where we think those interest rates will be. This is pre-tariff, though. And so it's interesting to see that before the tariffs came in, the predictions from the Mortgage Banker Association were that interest rates would not go down that much. The prediction was for 6.3%, an average of 6.3% at the end of 2026. So that's now almost 2 years away. And so even before the economic situation we find ourselves in, there was going to be a slow, methodical decline in those interest rates. And that's kind of, there was we were hoping for more. It may well be that even this doesn't play out. Say, I don't know if not anybody's quite brave enough right now to give a prediction, or maybe perhaps 2 or 3 different predictions, depending on which way the US economy goes. The other thing which is happening, and I think we have a little bit more clarity on it now, is really the situation with the MBTA zoning. And what we were predicting, and I think this is fair at this point anyway. An increase in the number of an increase in the number of sales as we moved out. I took it out to 2028. It was kind of brave of me, I guess fair to say. But hey, what the heck? I can only be proved wrong, all right, I guess. So I was expecting similar number of sales in 2025 that we saw in 2024. And that may prove right. More listings, slight decline in buyer confidence, and so the same number of overall sales in 25 as 24. But that over time, this really must begin to kind of loosen. That the housing market must begin to loosen. Sellers do need to sell, want to sell, and actually they will do that moving forward. So I had a modest increase in the overall number of sales running out to 2028. Now, layer on top the MBTA scheme, and this is where we do have a little bit more clarity right now, in that many of the predictions, large predictions in terms of the number of homes that were going to be built, has now been scaled back. We've seen that with the decisions made by the town. And so I think what I have here in terms of the number of new single family homes coming on the market, I think it's there or thereabouts. I might scale them back as I look at what happens as the year progresses, but I don't think it's going to necessarily be that much more than we see here, and probably what the town can absorb. And I guess that's probably as far as I would go at this point. But as we kind of move forward, as we get a little bit more clarity on this, I say we do certainly have some decisions. We'll be able to kind of put a little bit more in terms of where we think those homes are going to be. The one area I guess we do have clarity is in terms of the number of rentals. And my prediction here, this graph is the one I produced back at the beginning of the year. We are going to see a large number of new rentals coming on the market. And this almost inevitably will have an impact on landlords who are in the town. The majority of new rentals coming on the market will be 3-bedroom or less. So those landlords who have 3-bedroom or lower houses will find themselves impacted by this large number of new rentals coming onto the market. And as we speak, the majority of these have actually been approved. And by the time I do Q2, I suspect half year, I suspect that we'll have much more clarity in terms of how many of those are actually approved. But this looks to be where we're going to be, at least today anyway. So this will have an impact on condominiums, landlords, condominiums as well. I mean, will buyers choose to buy a condo, or will they choose to rent? I mean, they're very similar in terms of their overall characteristics of the home. And so there's a question there, I think, in terms of, and I talk about this in the market review, of where what impact this will have on the existing condominium market, existing condominiums market. Yeah. So what about the predictions? Well, the normal cycle of downsizing, move up and relocation sellers will have to wait until at least 2026. I think that's probably true. This is what I said in the market review. We are, though, seeing the more sellers coming on the market, specifically Q1 anyway. We'll see how Q2 plays out. But we are beginning to see a little bit of hesitancy on the buyers. We definitely heard, as soon as the tariffs hit, buyers being very, very nervous about what's going to happen. Clearly, that will work its way out. It always does. Within the next quarter, we should see some clarity over that. We always have to, I think it's fair to say. Be it a recession or be it not a recession, but there will at least be clarity. And so we are seeing buyers coming back in, but with that little bit of hesitancy. So it does look like if Q1 is kind of the model for the rest of the year, we will have an excess of inventory. And as the year moves on, unless the buyer confidence picks up, so we'll end up with some price reductions. We'll end up with homes remaining on the market. So not as strong a market as we've seen previously. Anticipate if that happens, that sell price to list price ratio begin to decline from that 102 down to closer to what we've seen historically, which is somewhere between 99 and 1. So that's kind of where I see the predictions for the rest of 25. I say it is a little bit, you have to be a little bit cautious with just one quarter's worth of data, and specifically this quarter. Once we get to Q2, it becomes much clearer in that then we will have got 40 to 50% of the listings on the market, and sales will have been completed by the time we get to the end of Q2. So based on that, we can then begin to start putting some full year projections in some of the data that you see here. So there'll be a little bit more to talk about in 2.5 months' time. So with that, I want to thank you for watching. Hopefully it was useful. As you can see, we do like talking about this. If you have any questions around what you think is happening in the Lexington market or any other market, or you have very specific questions you would like answered, please reach out to us. We'd be more than welcome to sit down and bore you with the details, because we're pretty good at that. So with that, thank you very much. I hope to see you again in the next video in a month or two's time. Bye.